Hello everybody, so in this video I want to discuss bonds, pretty unusual for my channel. Whether you've been following me or you're new to the channel, hello, I'm Alex and I'm 100% in stocks. For the matter of this video, it doesn't really matter if those are individual stocks, which is my case, or ETFs, but just as an asset class. I started out as a passive investor about 5-6 years ago, and then I did have like 70-30, 70% in stocks and 30% in bonds. I then chose, I will discuss all the considerations later, but I then chose to hold long-term bonds, individual bonds. But then I decided to sell out of them and move completely to stocks for various considerations, but mainly because I didn't see the point in holding bonds up until like 2 years ago, when interest rates were zero and the bonds were effectively yielding nothing, and they are considered, like the saying goes, that they are the safe part of your portfolio and they provide stability, safety, and reduce volatility, which might be true, and we will talk about later in this video. But I didn't think they were safe at that point because the yields were zero, they were giving you essentially nothing, and interest rates that were already zero, they could only go up, and when interest rates go up, the prices of bonds fall. So the longer the maturity of your bond, the more it falls. So I thought that there was only risk, there was only a downside, there was actually no upside, and I didn't see the point in holding them. Plus inflation, which I always predict there will be higher inflation. I thought so in recent years, I thought so 6 years ago, and unfortunately I was kind of right so far, and I think inflation is gonna be, we'll talk about that soon, but inflation is gonna be elevated in next years also. Inflation does also kind of erode the value of the bond. So I didn't see any point in holding bonds. I thought that they were only posing risks and giving nothing in return, no reward, only risk, and I didn't hold any bonds until now. But now interest rates are up, and I thought it might be a good point for me to reconsider bonds for my portfolio. As I have shared in previous videos, I just got a big lump sum of money, and I'm kind of more preparing my portfolio for a recession also, and I want to reduce the volatility, the downside of my portfolio in a recession. Plus, I'm focusing more on dividend stocks, on the income part also, because me and my family were already retired, and the income part is really nice. So I thought, why not bonds? They have this yield, like a 4.5% yield now, and they provide some kind of cushioning in case of a recession. And just as a part of an overall review of my portfolio, that maybe I should, in addition to individual stocks, which I pick, add some ETFs, which I will research in the next weeks and decide. But I thought, why not bonds? So in this video I want to discuss them, like the different considerations of bonds, things we should think about and consider when deciding, and give my conclusions in the end. So the first thing to discuss about bonds is the yields. Let's talk about the yields I'm talking about government bonds. I didn't mention that. Only government bonds for this video. Here we can see the interest rate, which was hiked a little bit just before COVID, and then reduced back to zero during COVID. And in recent couple of years, it was hiked and hiked and hiked, and now the Fed is planning to reduce it. But of course, it depends on inflation. The reason that they're hiking the interest rate is to stop inflation from raging. So all depends on the inflation. They cannot reduce interest rates as much as they want. So right now the interest rate is around 4.25, I think. And so the yields of the government bonds, I have it here. Those are the bonds for different time maturity. And we can see that from 3 months, 6 months, 12 months, up to 30 years, the yield is pretty much the same. Now I can see that already the 30 years is getting a little bit higher than the short-term bonds, which is kind of new because lately there is the thing with the yield curve, which usually long-term bonds, long maturity bonds should give much higher returns than short-term bonds. But in recent years, we had in recent years, we had an inverted yield curve, which means that, so this is the yield curve. This is how it was a quarter ago, and how it is now. So usually what we expect to see is an uptrending yield curve. So those are the yields of short maturity bonds, and those are the yields of long maturity bonds. And the longer the maturity, the higher the yield is supposed to be. But we had an inverted yield curve, which means that short-term bonds gave higher yields than long-term bonds. And now the yield curve is flattening. It has flattened, and now it seems that it's finally is getting back to an increasing yield. We'll see. But just to give a side note, that this usually is a predictor of a recession. Of course, we never know, but it's one of the indicators. So if we look here, we can see this is the difference, the delta between the 2-year treasury and the 10-year treasury yield. And we can see that every time before the recession, the gray areas are a recession, although I don't think the beginning of the 90s was a complete recession, but fine. But like a slowdown in the economy. And we can see that every time before there was a big recession, it goes back even before that. There was an inverted yield curve, and just as it got back to normal, the recession hit. So I'm not saying anything. I don't know. I don't want to be one of those who predict recessions. I have no idea. But just to mention it as a side note. So now we have a flat yield curve, which means that the bonds are yielding, the government bonds are yielding around 4.3 to 4.7. So this is the return that you can expect from investing in a bond. So when comparing this yield to a dividend stock, which a big asterisk, of course I'm not comparing them, I will explain that soon, to a dividend, as a yield of a dividend stock, 4.3% or 4.5% is pretty nice. It's on the upside. And when comparing to the income part of the S&P 500, for example, which is right now, I think it's yielding in dividends around 1.5%. So it's also nice. But of course, we shouldn't really look at it like that, because what really matters here is the total return. Because obviously bonds, all that they will give you is this 4.5% currently. But when you hold stocks, they have the inherent growth in them, whether those are S&P 500 or individual stocks or dividend stocks or SCHD or any ETF or any stock that's have a growth also besides the income part of it. But for bonds, it's gonna be just the income. So here we can see TLT, which is an ETF of 20 plus year long-term long maturity bonds, treasury bonds, versus the S&P 500. And we can see how over the years, and this is just from the year 2002, I'm sure that if it was a longer period, the difference would be even more staggering, when obviously your true returns in the long term will be from the asset class of stocks and not the bonds, really, because the bonds, all that they give you is this 4.5% and the change in the price of the bond. So we'll talk about the difference between ETF and holding direct soon. So we can see that long-term stocks are growing while bonds are not. And of course it's obvious, but I really want to stress it and mention it for whoever is watching it. So the 4.5% yield is also nominal. That is before inflation also. So if you expect an inflation of 2, 3, 4 maybe percent in the next decade, your essential returns from the treasuries will be almost 0, maybe 1% in real terms. Plus, there is no no actual growth, not anything besides this yield. So definitely, I think returns and yield are not the reason to hold bonds, especially for whoever is predicting an elevated inflation like me. So the yield and the income is definitely not. Of course, if I want this 4.5% income, there are definitely, I think, better tools for me, which will give also some kind of growth in the principal, also like ETFs, stocks, dividend bond stocks, anything, maybe real estate, maybe BTCs, anything that also has an inherent growth in the principal also. So for me, I think the yield is definitely not the reason to invest in bonds. So that's about the yield. So the second thing to discuss about bonds is the sensitivity to interest rates, how interest rates affect the prices of bonds. So when interest rates go up, the prices of the bonds go down, because when interest rates go up, the expected yield of the existing bond is also going up, and therefore its price should drop for it to give the same yield as new bonds, for example, that are being issued. So when interest rates go up, the prices of bonds go down, and vice versa. When interest rates go down, the price of the bond that is yielding more from before is going up, so it yields essentially less until it yields the same as the new interest rate. So that's the impact that interest rates have on all kind of income generating assets, including even dividend stocks. But on treasuries, the effect is really direct and obvious. So here we can see the history of interest rates in the recent decade, and here is the TLT ETF, the 20 plus maturity treasury bonds. We can see how the price, this is not the yield, just the price of the ETF, the principal, is affected by the changes in interest rates. When the Fed began to hike interest rates from 2017 up until COVID, we can see here the drop in prices of the bonds, and it was hiked only to 2.5%, and the long-term, long maturity bonds lost about 10% of their value, 8-9% of their value. And then when COVID hit, the interest rates were slashed back to zero, plus there was the sell-off in the market, which will be our next point. So it really hiked the price of the bonds by 50%. And now, since 2022, the Fed is increasing interest rates again, mostly to fight inflation, and increasing it more than it did so in 2018, 2019, and we can see how the prices of the bonds drop. So essentially, if you are expecting for interest rates to go lower in next years or decade, or whichever is your time horizon, bonds might be a good bet on that. But if you expect interest rates to go up, maybe you expect a high inflation and interest rates to not stay zero long term, then maybe bonds are not the way to go, and 4.5% might look like a high interest rates in recent 10-15 years, but actually it's just a normal interest rates, and the interest rates could definitely historically go higher. So for me, honestly, I don't know. I don't like to bet on interest rates. I don't have any thesis. I have no idea. I think the Fed will try to lower interest rates. I think the United States is overall interested in lowering interest rates because it has a huge amount of debt that it needs to pay back, and it definitely needs lower interest rates for the payments of the interest of the debt. But also it doesn't really have a choice because money printing is the new norm, and the amount of printing in the West overall is getting more and more prevalent, and so that will probably bring a higher and higher inflation? We don't know. I'm not sure. I'm just discussing both sides. And if inflation increases, the Fed will not have a choice but to raise interest rates. So I don't know. I don't want to bet on it. But at least now we're at a point where interest rates could go down because again, until 2018, when interest rates were zero, you didn't even have that option. They could only go up and you could only lose money on bonds. But now they could go down again. And as we can see again, here is the effect also of a market sell-off. But let's say, for example, from here to here is a 30% upside for a longer term bond. So I didn't think I mentioned, I'm sorry, but the longer term the longer the maturity of the bond, the stronger the effect of the change in the interest rate. So here I actually have it here. So here we can see this is a comparison of TLT, which is a 20 plus treasuries, IEF, which is around 10 years maturity treasuries, and SHY, which is short-term treasuries. And we can see how the hiking of the interest rates affected them all negatively, but with different strength. And the longer the maturity of the bond, the stronger the effect. So it will lose more money when interest rates go up, and it will make more money, gain more when interest rates go down. So this is about the interest rates. So the third thing to consider about bonds, and one of the main reasons experts are recommending to have a portion of your portfolio in bonds, is the cushioning in case of a market sell-off in recessions, where in some cases, most maybe of the cases, when there was a big market sell-off and stocks crashed, bonds went up because people are moving away from risky stocks in panic and putting this money into safe bonds. So it didn't really prove itself in every market sell-off, but here we can see the last two big sell-offs, which were 2008 and 2020, and we can the blue line is S&P 500. We already looked at this graph, and the orange line is again TLT, which is a 20-year maturity plus bonds, treasury bonds. And we can see here that indeed, when the stock market crashed in 2018, we can see a small bump here. It's just maybe I should have somehow logged this graph. I'm going to show another graph soon. And also in 2020, in the huge market sell-off what we had in March 2020, we can see there is a spike in the bonds also. I have another graph to show it, which is here without the S&P 500. It's gonna be easier to see that in 2008 again, when when came the huge market sell-off, we can see here the big spike, and also in 2020. So here we again can see that the longer the maturity of the bonds, the stronger the effect. So again, the orange line is the longest maturity of 20 plus years. The blue line is around 10 years, and the purple line is the short-term treasuries. So we can see that if you want to have a cushioning from market sell-off to decrease the volatility of your portfolio, so when stocks go down, bonds go up. Again, it didn't prove itself every time from my understanding in the 70s when there was a market sell-off, but accompanied with high inflation also, bonds also went down. Stocks and bond together went down because inflation really affects bonds also, which we'll talk about soon. So as long as it's not a high inflationary environment, bonds could give this cushioning, again, not 100% in a case of a market sell-off. So essentially limiting the downside of your overall portfolio, and creating opportunity for maybe in this case also to sell some bonds when they went went up and buy more depressed stocks and then enjoy the ride out of the recession, which would be my plan if I did decide to buy bonds. Again, it's not going to be for the yield. It might be to prepare my portfolio, as I said, for a recession. So if I did hold bonds, I would probably choose the longer term, because the yield I don't care about. I think it's essentially still nothing in real terms, but it could give this cushioning. Spoiler alert, I'm probably not gonna do that, but that's one of the main cases for me for maybe to put a small portion in bonds. So again, the cushioning of your portfolio, the lower volatility, the limiting the downside, and the flattening out market volatility in your portfolio. The fourth, I think I'm on the fourth thing to discuss about bonds is inflation. The very painful topic of inflation. So I already mentioned how inflation might make the yield of bonds essentially almost zero, or only 0.5%, 1%, eroding the real returns, the real yield of the bond. But much more than that, I think inflation is the ultimate enemy, nemesis of bonds, because when you buy a bond for $100, what you get at the end of the period, be it 3 months T-bills or 30 years treasury bonds, what you get back is $100, which with time is guaranteed to be worth much, much less. So bonds are essentially an asset class that doesn't protect your purchasing power. And here we can see the history of the purchasing power of the US dollar, where up until the 40s, the 50s, where the debasement from the gold standard began, that there was essentially no inflation, there was essentially no wiping and the devaluation of the purchasing power. But as soon as the US dollar and following all other currency began, fiat currencies, which have no backup in precious metals anymore, we can see that the money printing began and the inflation and the erosion of the purchasing power began and continued and continued and continues to this day. And just to mention as a side note that no currency in history survived this phase of devaluation after it has become a fiat currency. No fiat currency in history survived at all, and there were many attempts in the last thousands of years. So I'm not saying anything. Maybe this time it is different, but again, just a side note. So here we have the money supply. This is exactly from those years when the debasement from the gold standard was complete, and since then printing and inflation were the name of the game, and it's probably gonna continue like that, if not even accelerate, as we've seen during COVID. It was absolutely unprecedented, the amount of money printing, and then therefore the I have to say relatively moderate inflation we still had. I think the Fed is still trying to fight off the inflation effect, which is still a big risk until now, from as an after effect from this money printing. So when you hold bonds, you essentially have no preservation of your purchasing power over time. And I think in those times, any asset I hold, I want to be able to preserve its value in real terms. So if there is inflation, for its price to increase with the inflation also, be it real estate, be it stocks, be it maybe gold, maybe even Bitcoin, anything that really preserve my purchasing power and preserve my capital against this inflationary tax, essentially. So for me, that might be the biggest reason, not might be, this is definitely the biggest reason to avoid bonds. And I don't mean T-bills, by the way, I didn't mention, but of course, when I say I'm 30% in cash right now, the idea is rotate to T-bills. Obviously, I'm not talking about T-bills in this case, which is just a cash position, and you refer to it as cash and you know you're sitting on cash. I'm talking about about a bond as an asset class, as a strategic allocation to bonds in your portfolio. I think that this is the part of your portfolio that will totally lose purchasing power over time and be devalued and eroded. And this is the biggest reason for me to avoid bonds, honestly. So this is about inflation. So the fifth thing to discuss about bonds is holding individual bonds versus holding funds or ETFs of bonds. So an investor can buy individual bonds and hold them directly, or a fund that includes a lot of bonds inside. So the main considerations, it's pretty much the same, but the main considerations will be that when you hold an individual bond, first of all, you don't have an expense ratio. Your taxes might be lower. It is in my case, and you can hold the bond until maturity. So if you hold the bond until the end, to maturity, the effects of the price do not affect you. So if you buy a bond now for, I don't know, 5 years, 10 years, which yields a 4.5 currently, 4.3, and you hold it until maturity, whether interest rates go down or up, or there is a market sell-off, for example, or anything that will affect the price of bonds overall, yes, your principal will be affected by it, but as long as you hold until maturity, as you get close to the maturity, the price of the bond will just adjust itself to the end of the maturity, to the last payment of the principal and the interest, and you will just get this 4.3% each year, regardless of what the price did all along. While if you hold a fund, an ETF, there is no end to it. You hold it as long as you hold it until you sell it, and any change in the price, in the principal of the bonds will affect you. Again, you can just not sell it and continue to get the dividend, the payments, the interest, but of course it still affects your overall portfolio. You never know when you do need to sell it, and the price will affect you when you have no escape from it. So this is the main difference. In terms of maturities, you can hold an individual bond, just a long bond or a short bond. Again, I'm not talking about T-bills, but of course T-bills also, or you can just construct it the way that fits you. There is the concept of laddering, where you buy different bonds for different maturities, and they all serve different purposes and kind of give you a diversification of bonds and the benefits and pros and cons. Or you can just buy an ETF that does all that already. So and you have different ETFs, different funds for different purposes. So you have the long term, like we saw the TLT, the midterm, the IEF, and the short term, the SHY. Those are just examples. There are many, of course, ETFs and funds, and there are also ETFs that include all kind of maturities and different blends. So I think it doesn't really matter. For me, when I held bonds a few years ago, I chose to go with individual bonds. I just wanted to have more control, but I really think it doesn't really matter. I did want to have the option to hold them until maturity and to know that the price might not affect me, but I don't think it's the complete story, because I did buy a very long maturity bond. So obviously when the price falls, it will affect me, because if I have still 20 years, I can say the same thing about dividend stocks or even S&P 500. Of course, when the price falls, it affects you, even if you know that eventually you will kind of break even or will get out of it, but you never know when you need to sell. So I don't think there is much of a difference, honestly. So yeah, so those are the 5 considerations. I hope I covered most of what we need to think about and consider when we think about investing in bonds. For me, I think I'm gonna skip it for now. To put around 20-30% of my portfolio in this non-capital preserving asset is absolutely not an option, especially with me expecting higher inflation in the next decade, for example. Of course, I don't know, but this is a risk I'm scared of, and I want to protect myself from it. So bonds are definitely not the way to go. And, I don't know, putting just 10%, 5% to just have have this upside from a market crash. It will not give me a lot, and I never know when this crash might come, and it might still not come for many years now. And even if it does, 5%, what kind of cushioning will that give me? Even 10%, and still 10% also seems a lot to me. So I'm just deciding to avoid it. For me, the main reason was for the yield, which again, I think in real terms it's gonna be absolutely nothing, and the cushioning in case of a market crash. But the inflation really scares me, which brings me to maybe why not gold. Gold will also give cushioning in case of a market crash. I think I need to check it out, but conceptually it should, and it is also a kind of protection from inflation, especially high inflation. It's not the best, but I always want to check it out for years now, and I'm always delaying that. So maybe that's the time for me to really kind of grab this issue and check it out more deeply and decide maybe I do want to put a certain portion of my portfolio in gold to protect myself from a scenario of high inflation and also from hyperinflation, which I don't want to subscribe to different conspiracy theories, but I think it is a plausible scenario. I don't know how plausible, nobody knows, and we will never have the right answers, but it does scare me a little bit. I feel uncomfortable with the amount of, as I mentioned already, of money printing and the devaluation of the currency and where the fiat currencies are going. So maybe gold might be a way to go and also give me that cushioning in case of a recession that I'm looking for. So yeah, so that's it about bonds. I hope I covered everything, and I'll see you in the next one. Bye bye.